All right. For those that are joining us, thanks for joining us. I'm excited about this webinar. We have our guest Michael Enyart today, and he's here in Colorado. We were talking about Colorado before we started recording here, but David and I have worked with Michael and his team, and the founder of WD Wealth Strategies is Michael Duffy, and we've worked with him a lot too. And they are an incredible organization that I mean, broad range of topics, but they've helped us with corporate tax strategies, individual personal tax strategies, with what a lot of people hear of as infinite banking. They like to call it bank replacement strategy. David and I both use that strategy to set our children up with insurance policies, and then ourselves, and use that as an investment tool. But we're going to get into a lot of that today. Michael had told me about a super ninja tax strategy that not I don't think a lot of people know about, and so he's going to brief that, but he's going to also talk about a lot about more. What about what? But Michael, I'm going to turn it over to you, buddy.
Hey, that was a great intro. Thank you for that, Stu. Michael,
Yeah.
if you're not impressed now, just let Stu keep talking. And you're going to be highly impressed. It's going to be amazing.
I love it.
Tongue-tied. Michael, over to you, man.
All right, sounds good. I thought maybe a fun question to ask to get started. This is like probably my favorite. I call it financial trivia. Don't know if it would qualify as trivia, but I don't know if you guys have ever heard this example or this analogy. But when I was young, my dad came to me, and he asked me, Michael, would you rather have a penny that I doubled every day for a month, or $1,000,000? And he let me think about it for like 5 seconds, but he made me answer sort of quick. And I said $1,000,000. Because I didn't know like how quickly that penny is going to double. Is it going to get above 1,000,000? I wasn't sure. So I'm going to tell you guys what a penny would be worth if doubled for a month. But before I give you that number, just in your head, if anyone wants to write it in the chat, feel free. And Stu or David, feel free to say, throw something out loud. But any guesses what a penny doubled for a month would be?
I'm curious. I'm curious for chat answers first before I throw something out. Somebody give us some answers in the chat.
And stop Googling if you're Googling.
No Googling. Paul, I know you have an answer, dude. I know you're in the financial industry. Come on, man.
And it's a leap year, and we're in February. So I should.
I've heard this one before, but I got to be honest with you. I don't even remember what it was. I think it was actually close to like a $1,000,000, right? Something around there over that 30-day period. Double it up, right? So the rule of 72 on that one.
Yeah. Russ guessed 10 million in the chat. I was going to guess around 3 million.
All right, perfect. So the answer for a 31-day month is 10.7 million. So Russ coming in with a very close number.
Nice.
And yeah, obviously 30-day month is only 5 million or so. This February is 2.5 million, and a normal February is 1.25. So I think that's a super fun just anecdote for compound interest and how quickly it works. But where I want to introduce just another twist to it is, let's say if instead of just doubling that penny every day, we decided to tax it. So every time you make money in this 31 days, at the end of the day, you're going to be taxed on what you made that day. So obviously you'll end up with less money because you paid some taxes. My numbers use a 37% tax rate. I'm curious if anyone wants to just shoot out a second guess, knowing that it was about $11 million with no taxes, what that might be worth with taxes.
3 million.
17 cents. 17 cents.
Well, I will say David is closer than Stu. The answer is $14,600. And I think that definitely surprised me when I heard that the first time, that it would go from 10.7 million down to $14,000. That's a stunning drop to me. And what's the point of this story? I'll say, well, one of the things that we do, and we're going to talk about a couple different strategies as we get further into the day. But one of the things that we do is we are trying to maximize wealth efficiency, right? We are looking to do anything which will just make our client situations more efficient, which probably the biggest obstacle that most people face on their journey to wealth is taxes. So a huge way that we're looking to make a client situation more efficient is by reducing taxes. And if we're able to do that, we can even say reducing unnecessary taxes. And so in that example, obviously, no one's out here earning 100% a day or even 100% a year for any length of time on their investments. But I think the sort of lesson that anecdote taught me is just how big of a difference, number one, taxes can make in your life. But when you try and understand financially what's actually happening and why those compound interest numbers end so differently, it's because of this pretty cool fact of how compound interest works, which is that each additional percent you earn in your rate of return gives you dramatically more of net earnings than the previous 1% that you earned did. So if you were to look at an 8% return, a 9% return, and a 10% return, you compound that out on one of the calculators you can find on Google really easily. The difference between 9 and 10% is significantly more than the difference between 8 and 9%. So when you look at the penny doubled every day and that with taxes or not, what you're actually looking at is 100% a day return versus a 63% a day return, because that's your 100% minus taxes. And the lesson there is just each additional percent that we can, squeeze water out of a rock is going to go further than the last percent. So when it comes to things like saving taxes or other wealth efficiency strategies, my focus is, I'm a big believer that in the financial world and personal finances, it's mostly just your behavior, right? If you save more than, if you save consistently over time and you invest it, you're going to do pretty well. That's probably 80% of the game. But we also have head knowledge. And so we're going to talk about a couple different ways today to save on taxes. And also at Stu's request, we're going to dive into some even more wealth efficiency strategies to try and squeeze water out of rock and just do everything we can to minimize things like lost opportunity cost, et cetera, to add an additional percent, onto how fast our net worth is growing every year, so to speak. So first thing I'd love to just jump into is what we call the bank replacement strategy. Stu, you mentioned it's similar to infinite banking, and it is, but we do things a little bit differently than people who have done infinite banking in the past. So I would say if you're familiar with that, listen in, because there's a few things that we do which are going to be different, which could, pretty fundamentally change how the numbers end up playing out. And I'll just mention, if anyone wants to ask questions as I'm going through this, I love it. If you have any challenges, love to hear them. Feel free to put them in the chat or even just unmute. And as I'm talking, let me see if I am able. I'm just going to share my screen real quick and go through a couple numbers. Can you see the mountains?
Yep, looks good.
Speaking of Colorado, we don't have. Let's pretend this mountain was not this photo was not taken in Colorado, because it's quite a beautiful photo. So I'm just going to real quick, briefly go through. I'm sorry, I'm trying to get it to change slides. Give me one sec. All right. So I'm going to go through real quick just the typical challenges that almost everyone is going to run into throughout their life that the bank replacement strategy is hoping to solve. So on the left there, you can see some typical challenges. Problem number one is where to store your savings before they're invested. This is something everyone is going to have to come up with an answer for. Almost everyone I talk to does one of three things. The first is they just put their savings in a savings account and sort of accept that they're not going to get a good rate of return while the dollars are sitting there. The second thing I hear, on occasion, this is definitely a lot less common, is throwing money into the stock market, like a S&P 500 index fund or something like that. And the third is various versions of, infinite banking. Other names that this goes by are bank on yourself, becoming your own banker, and bank replacement strategy. And essentially all of it is trying to solve this second problem, which is lost opportunity cost on our savings. This is something we're all going to have. And you'll see I put in there, I'm a pretty big believer that the solutions we've found work better than some of these other alternatives. And we'll get into that as we keep going. But what is the bank replacement strategy hoping to accomplish? Well, if you're not super familiar with any of these terms, I'll just start by giving the brief summary that bank replacement strategy involves, instead of putting your savings in a savings account, contributing them to a whole life insurance policy, which is overfunded so that it has a cash value. And that cash value has the potential to grow, and it tends to grow, generally speaking, every year. So some of the benefits of doing that, as opposed to storing savings in, a savings account or even a high yield savings account, would be over time, you end up with a higher rate of return on your cash inside of these life insurance policies. That return comes in the form of both growth and dividends, which are tax-free. And then this next one here is one of my favorites. It's an attorney's term. It stands for non-direct recognition. This is a concept that insurance companies came up with, in my opinion, to make money at the expense of people who have life insurance policies. Essentially, and some people are familiar with this, but most people haven't heard of it. So if you haven't heard of it, I wouldn't worry about that. Oftentimes, when you have one of these life insurance policies that's overfunded, you've paid in more than you needed to for the death benefit, you've built this cash value, which you can now access. Oftentimes, when people access their cash value, they're doing it via a loan, right? You could either take withdrawals or you could borrow money from the insurance company. And when you borrow the funds out, many insurance companies do something called direct recognition, where they're going to directly recognize that you took that loan, and they'll penalize you in one way or another, but usually it involves them changing your dividend. So instead of paying you the same exact dividend, they'll look at how much of a loan you took and adjust that. Last two things I'll hit real quick is we're doing sort of three things simultaneously with the same dollar. First is when we put that dollar, when we overfund a life insurance policy with $1, you're building cash value inside of that life insurance policy. But it's also a life insurance policy, so it also gives us a death benefit. And thirdly, we can borrow against the life insurance policy and access that cash and go make an investment. This is how most of our clients are using their life insurance policies. And you can imagine $100 going into the structure. You have your $100 of cash value that's growing. You also get the death benefit, and you can also borrow cash out to invest that elsewhere in, let's say, a real estate deal you're looking at. And then finally, one thing, if you're familiar with these structures, is that generally speaking, when you set them up, there's a period of time where you don't have full access to your money. And that time creates lost opportunity cost. It's, in my opinion, the biggest reason not to do a strategy like this to generate higher yield on your cash, is because there will be a period of time where you don't have access to everything you put in. And so one of the solutions that we've come up with to try and solve this problem is we've given our clients access to 90% of their cash. 90% of what they contribute is available immediately in the form of cash value. And that highly minimizes the, let's call it the lost opportunity cost of, instead of doing this, doing something else. Real quick, I just want to show this quick chart to sort of give you an idea of what these three different options that most people are doing, which various features we see. So savings account, savings accounts, number one, when you get a return on your savings account, which, even right now with high interest rates, the average savings account is only paying out, I think, about 50 basis points. But even if you set, if you search out those high yield savings accounts, which right now are paying around 5, that's taxable. So, 40% taxes, you're going to end up netting 3%. I say high yield here. Of course, that's like, everyone has a different definition there. What I would just like to stress is that sort of whatever interest rates are, you can expect a savings account to perform, over time, the worst of these three options, a life insurance policy that you design specially as a bank replacement strategy to perform better than the savings account. And then, of course, the S&P 500 index fund will probably outperform any type of cash equivalent. And then if we look at the death benefit here, obviously only the life insurance policy has that death benefit. Immune from losses, we see that in the savings account and the bank replacement strategy, but of course not the stock market account. And then always liquid here. Definitely, this is semantics. You could absolutely check that the S&P 500 is always liquid, but I wanted to challenge how people think about this real quick by just bringing up the fact that if you are using a stock market account to store liquidity, let's say you plan on buying a rental property in a few years, and in the meantime, you throw it in the S&P, what I think you're going to see is, there's years where it's down. And so even though you might end up with a higher return over a long period of time, if the market's down 20%, since you started saving for a real estate property, yes, it is technically liquid, but in practice, people don't liquidate it at a 20% loss, right? You have to wait until it goes back up if you don't want to lose money. So sure, it is liquid, but I just want to throw that out there that you could be at the whim of the economy if you're going to actually access your capital without a loss. Real quick, before I move on, I want to ask another quick question, see if anyone either in the chat or wants to unmute. Does anyone have a guess as to who is the biggest purchaser and owner of cash value life insurance products, like in America?
Probably Warren Buffett.
Got it. Okay.
Banks. I would guess banks.
Yes, I think.
Yeah, I was going to say JP Morgan or Wells Fargo.
Yes, and I think Warren Buffett is a great answer. I was thinking more generically, like categories of people, rather than an individual. But yes, the balance sheets of banks are public, and one thing you'll find is that banks own a tremendous amount of cash value life insurance. So much so that it even has its own name. They call it BOLI, B-O-L-I, bank-owned life insurance. And it's something you can Google and read all about. But banks are putting tons and tons of money into cash value life insurance. When you look at what percentage of their tier one capital they're keeping in life insurance, obviously, if we look halfway down the slide at Bank of America, 24 billion, Bank of America has hundreds of billions of dollars in assets, right? Deposits that they've invested. But when you look at their tier one capital, that a huge portion of that is in this cash value life insurance product. And And it sort of shows this dichotomy that where are we storing our cash? You know, when you ask almost anyone, they say, I'm keeping it in a savings account. But where are the banks storing their cash? They're storing it in cash value life insurance policies. So, you know, and of course, why are they doing it? Sort of those things I mentioned earlier. Just a higher yield on your cash. You also get death benefits in force, which you can imagine from a corporate standpoint helps when you have a key executive die or you need to pay out a retirement benefit, etc. But what I want to do real quick is just take you through, because I feel like these strategies, they're cool to hear about, but what I really like to do is look at real life examples of people who are using these strategies. So the next couple slides are just a few of our clients who have used these strategies. They're real clients. The names have been turned into initials, and the pictures aren't the actual people. But I thought these were helpful anecdotes. So to start with, this client came to us, and they had two things that they wanted help solving. The first was this client had a very high net worth, was expecting, in their case, a very large estate tax when they passed away of about $40 million. And additionally, they were about to purchase an apartment building, and their down payment was going to be $1.8 million. So what we helped them do is we helped them leverage our bank replacement strategy, and we funded a life insurance policy with a contribution of $2 million. And number one, that immediately gave them access to do a 90% loan against the cash value and take out that 1.8 million. And so in other words, right, they still had the liquidity to do their transaction that they wanted to do. But we also got in force for them this $40 million death benefit, which will come to their trust, both income tax-free and estate tax-free, so that their portfolio of real estate, you know, they won't have to liquidate it when they pass away. They'll be able to use that death benefit to cover the estate tax. One other quick example here. This client is a very dear, very old friend of mine. About 20% of their net worth they kept in cash, which might seem like a really high number to some of us, but maybe not others of us. But they did it for two reasons. The first was a lot of real estate in their family, both real estate that they had inherited and also real estate that they had purchased themselves. And it was all highly levered. And so they felt comfortable, you know, that they were taking more risk by investing in levered real estate to keep, you know, a larger portion of their net worth as cash, in case, you know, interest rates went up, or in case, you know, of course, they have vacancies and things like that. And then additionally, just the belief that there will be a recession, and they wanted to have dry powder ready to go buy more real estate when that happened. And so between those two things, they had about 20% of, you know, a rather large net worth just locked up in cash. And so what we were able to do using this strategy is move it over a period of several years into a life insurance policy, which dramatically increased their yield and also gave them a $3 million permanent death benefit, which is now fully paid up, meaning they actually never have to pay any more premiums and they'll still get that death benefit. One more example I wanted to dive into, because I wanted to hit this idea of infinite banking. This was, let me see if I can remember the dates here. This was back in 2020. We met with a client, and I have permission to share his situation. And he was doing what's called infinite banking, which is similar in a lot of ways to what we do. However, he was doing it without that feature that I mentioned earlier of non-direct recognition. He was doing it with a life insurance company called Guardian, which is a very strong, very good life insurance company, who currently today actually lets you choose between direct recognition and non-direct recognition. But in the past, and for policies issued in the past, no one had that option. They were just given this direct recognition structure. And what that meant was that every time our client took a loan from his policy, his policy was being penalized, sometimes by lowering the dividend and sometimes by just excess interest. And so we did a deep dive project into this, and we spent, I want to say, over 100 hours meeting with guardian representatives, running the numbers, and we compiled that in essentially every conceivable situation, this direct recognition feature was dramatically hurting the performance of he's a client now, he's a prospect back then, of his policy, to the tune of $4 million over the course of the rest of his life, which was significant. I've, for about 7 or 8 years now, known that I prefer non-direct recognition over direct recognition, but it's so complicated, right? Because you don't know what the future holds, and you don't know exactly how you're going to use your policy. When are you going to keep it in cash, and when are you going to pull the trigger and go invest in a mobile home park or whatever the case may be. And so we really dove into it, and I believe we, at that time, became one of the country's experts in this subject of how the direct recognition affected the policies, and also just being able to show without a doubt that if you're going to be doing a bank replacement strategy, you should be doing it with this non-direct recognition mechanism. I just realized there's a typo. You'll notice in the top right, it says 9 million, and in the bottom, it says 4 million. 4 million is correct. So apologies for that typo there. But I would say overall, this strategy, going back to sort of what I said at the beginning, we're looking to wring water out of rocks. We're looking to find every opportunity to add to our wealth, right? Because that's the key to freedom. And almost every single person, including probably everyone on this call, you will have lost opportunity costs throughout your life because you have those dollars sitting in a savings account or a checking account, as opposed to a product that has a higher rate of return. And the solution is not to throw everything in the stock market the second you earn it, but we believe strongly that almost everyone can benefit from a structure like this. We've worked with Stu and David on that. I'll pause there. I'm curious if anyone has any questions. Stu, do you feel like, of the things that you find compelling, is there anything you would want me to add there?
I'll open up for questions if anybody has any, but then I can offer some thoughts. Anybody?
I got a question. So it might be getting a bit technical, but concerning the cash value aspect of it and the availability within a week of a policy being placed in force, is that, like, for instance, your first scenario or client, $2 million available? Is that?
No. Okay, sorry, go ahead.
Yeah, no, my question is, was the 2 million available within the first week, the total amount paid into the policy?
Yeah, so $2 million was paid into the policy, and of that 2 million, he had cash value of 1.9 million, and we were able to get a line of credit of 1.8 million. And so we pulled out 1.8 million of the 2 million, and
Okay.
that was done within a week of the policy being issued and the wire being sent to the insurance carrier.
Gotcha.
And I think that's I think people who are familiar with this strategy and who have done it themselves even will relate with the statement that their policy probably did not have the ability to do that. It's very unique to have cash value that high. And it's a combination of, number one, just how we design the policy, which insurance company we're doing it with, which chassis we use, etc., like all those technical decisions. But I think the thing that most people will most relate to and most understand is that insurance companies can't usually give you such high access to all of your cash because they also have to pay out a commission to the advisor. And sometimes these policies have really high commissions. And so they don't want to get, raked over the coals if they're paying the advisor commission and the client's taking basically all of their money back out. Because then they have a $40 million death benefit that they've put in force without, cash to invest for them. And so, one of the things we've done is we've changed how we structure these policies to, number one, reduce our commission to the lowest. As far as I'm aware, the lowest in the industry is what we get paid on these. And then secondly, not only is it low, but we spread it out over a period of 10 years to absolutely maximize how much our clients can get paid or can access in their policies. Yeah, thanks for the question.
Michael, what have you seen as far as the average number of years it takes for the cash value portion of an insurance policy to, I guess, have a higher value than what you have initially put in for the required, upfront costs and then annual costs? I think I remember something around like 3 to 4 years. Is that what you're tracking?
Yeah, that's very common. One thing I'll point out though is that the higher interest rates are, the quicker it'll happen. And the lower interest rates are, the slower it will happen because
Gotcha.
Insurance companies pay you a dividend, which is tied, generally speaking, to interest rates. So right now, these policies actually have really low dividend rates. And depending on your health, it could be year 4 to year 7, let's say. If interest rates go up over the next several years on these products, we could be back to 3. It'll just vary year to year and based on your health.
Cool. Makes sense.
Yeah. But yeah, great. Let's also shift over and just discuss taxes real quick. I know that's everyone's favorite subject, but hopefully if we're talking about how to pay less, it'll be a little bit more exciting than taxes normally are. So I mentioned this earlier in the call. And actually give me 1 second to get sorry, my slides seem to have frozen on my end. I'm just gonna stop sharing and then reshare. Apologies, my computer's freezing a little bit. Just give me 1 second.
While you're doing that,
Michael, I think this is a great opportunity to ask you an important question that's a debate within our business. Does your computer happen to be an Apple product?
It does not. No. I'm on Windows 11. I think it's a Surface Book.
Dang it. Yeah, I'm on the anti-Apple side, so I'm technically on your side on this discussion, but you're disappointing me a little bit. But it's fine. You're doing a great job.
Well, we can blame user error if you want. Yeah, I'm I grew up totally against all Apple products, but recently made the switch over to basically all Apple products personally, but the work computers.
Well, and that'll conclude our podcast and webinar for today. Thank you so much, Michael, for showing up. No times for questions. I'm just kidding.
But I will say I'm not paying $4,000 or whatever it is for that headset that they just came out with. I feel like it's a bit much for a headset that other people are doing for a quarter of the price. Okay, great. Can you guys see my screen again?
Yep, looks good.
Okay, perfect. So one of our big mantras here at WD Wealth is that taxes are the single biggest obstacle to building wealth. And I'm just checking the chat real quick.
Not related to this current subject, by the way. So don't.
Perfect. Okay, yeah. Let's jump back. So taxes are one of the single biggest obstacles we face when trying to build wealth. For people who work 5 days a week, and who are paying around 40% in taxes, I just always like to point out that that's 2 of your 5 work days are going to paying taxes. In my opinion, that's a little bit much to be paying. And so a huge part of our business has been looking for ways to reduce, once again, we could use the term lost opportunity cost, right? If we could take every dime we've ever paid in savings, put it in an investment, and earn a good return there, imagine how much wealthier all of us would be. So there's dramatic lost opportunity costs when you pay taxes, but the alternative seems to be you go to jail. So I'm here to hopefully present one of many different ways that you can reduce your taxes in a way that's, of course, legal and safe. So jumping in real quick, we're going to look at real quick before I reveal the sort of the name of the strategy. So at the top, I just have it say tax strategy. Common issues we see, number one, depending on your situation, you could be in a very high tax rate, particularly if your income is higher. I have clients whose tax rate is over 50% in some states. Oftentimes clients come to us and they have no tax strategies that they're using currently. Something I hear very often is, I didn't think there were tax strategies for me, right? If you're a W-2 employee, a lot of people think that there's not necessarily anything you can do on the tax side of things, which is not true. Current year planning only. I'm referring to sort of 2 things here. The first is if someone comes to me and, generally speaking, I hear 2 things all of the time. The first is when I talk to my CPA, I talk to them in April and they tell me there's really not much I can do, right? And that's because when you're meeting with your CPA, generally speaking, they're looking through the rear view mirror. And just like in your car where you would have a rear view mirror that's small and a front windshield, which is huge, when you're doing planning, when you're planning for the future, there's so much more you can do to reduce your taxes than if you're thinking about last year. And the second thing I'm referring to here is, generally speaking, even if you do have a proactive plan, it's pretty hard to go back in time. Not a lot of strategies you can amend a tax return for example. And of course, that last typical challenge is when you send those funds to the IRS, they're gone for good, right? We don't, in the event that we overpay, they generally don't pay you interest. There's some times when they do, but generally they don't pay you interest on an overpayment. And it's not like we get a return on that money. So we're going to look at a tax strategy today. And the purpose of this tax strategy is going to be to show you guys how to earn a return on your tax capital. We can also use it for previous years when we combine it with the current year. We can go back up to 3 years. This strategy works with all types of income, so passive, active, business, employee income. We can find a way to make it work. This is a strategy that we can utilize, the bank replacement strategy that we just discussed. If you have a structure like that set up, it'll work well with this. So we'll get into that. And then the second thing here, I always like to point this out to clients, is tax savings are tax-free, right? So in other words, if I were able to save you $10,000 in taxes, you're not going to then owe taxes on that 10,000, right? So you'd almost have to earn like 15,000 or more to net 10,000 in actual cash. That's not something we have to deal with when we're looking at tax strategies. So diving in, we call this strategy the solar strategy. Now, before I jump into what it is, let's start with what it's not, because it is not putting panels on your own home or on your business or buying solar tax credits. When I say solar strategy, almost everyone hears it and they automatically think of something. And this is probably not something you've looked at. But what it is and I'll explain all these in just a minute, but it is the starting of a solar company. That's A. B is purchasing turnkey solar projects. C is receiving the significant tax credits and deductions that come from purchasing those solar projects. And D is collecting passive income from those projects. So let's talk about the projects real quick. These are commercial properties that are looking to get solar installed on their roof. Some people are doing that for environmental reasons. Other people are doing it for economic reasons. What you will see very often, our clients are tax efficient taxpayers. What do I mean by that? I mean, they might be a nonprofit, like a school or a house of worship. Before we started recording and before everyone hopped on, we were talking about people who moved to Puerto Rico to save on taxes. Certain people who invest in real estate as real estate professionals have too much depreciation. They can't use it all. And so there are certain people who are just tax efficient by nature, right? It could, like those three categories I just mentioned. And so though if those taxpayers own a commercial property, right, their school, the building that the church or mosque worships in, and they're interested in switching to solar, they're not going to recognize any of the tax benefits that come from solar. So what do they do? Well, they look for partners to come in and purchase the solar project that goes on their roof. And that's where we come in, connecting our clients to people like this. We work with a solar developer. We've done everything we can to make that as turnkey as possible. And so what ends up happening is this solar company that you start, which I'll say, probably this morning, no one on the call thought, hey, I should start a solar company today. But what I'm going to try and convince you of is that the benefits of it are so great and it's so easy to do that almost everyone who has tax liability, going forward, but also the last few years, should consider this. So you've started the solar company. We've connected you with this, let's say it's a school who wants solar panels on their roof. And so then you purchase the project and it gets installed by the solar developer on the roof of this school. Well, we're going to force that school to sign a 25-year power purchase agreement with you, or rather with your solar company, so that they don't just switch to, going back to Excel the next month. You'll notice I have on here tax benefits vary, but on average, it's around 75% of the purchase of the asset. I've seen more, I've seen less. It also depends on what state you live in, because some of the benefits are better in certain states. And if we just stopped here, you might have a compelling argument that, hey, you could go into this business, start building passive income, and it'd be a business where the government is essentially paying for 75% of your costs of goods sold, right? That would be intriguing, and that is intriguing, but it wasn't enough for us. So we began to try and financially engineer a product which made it more attractive. And so the final version that we share with our clients has seller financing. When I say seller, I'm referring to the solar developer who develops this project and sells it to your solar company. We have seller financing options through them, which allows us to, in year one, so immediately, generate more in tax savings than you actually paid for the project in cash. So what do I mean by that? Well, using the example of 75%, imagine you put $100 into a solar project and your return was $75 in tax savings. Well, when you incorporate leverage, if you bought that same project with $65 down and you seller financed $35, well, you're still getting the same exact tax benefit of $75, but now you only put $65 in. So you can start to see, oh, wow, there could really be something here. And that's where funding it with tax capital comes in. There's sort of two ways you could do this. Like, understand the more simple to understand way would be, hey, I'm going to put 60 $60 in and the government will send me $75 back. And that works. And you can absolutely do that. But something we've been helping our clients do is don't send the money to the federal government in the first place. Instead, fund a solar project with it. And then you don't have to wait to get your return, so to speak, back from the federal government, because you never have to send it to them in the first place. And when you file your return in April or in October, you'll be able to show all the tax benefits from this solar project, and they won't ask for any additional capital. The multiple, right, the total return that you get back, like I said, like it's all going to vary a little bit, but an average about 1.4 is what you can expect. And remember, this is on tax capital, right? So dollars which we would have sent to IRS expecting to never get back, we're able to 1.4x those dollars, which is in my opinion pretty significant. So I'm going to show you real quick. This is an example, a sample solar portfolio. I chose a number of $400,000 just because it was a very round number of the quotes that I had. And then I'm also showing you someone who lives in Colorado. Colorado has a tax rate of about 4.5%. So it's about the country's average. Of course, there'll be states with higher tax rates and states with lower, but I wanted to show you some pretty average numbers. And when I hover my mouse over my screen and highlight it, can you guys see that?
A circle pops up.
Okay, perfect. So what this project is showing you, I want to walk you through a couple of details real quick. The first is a portfolio. In this portfolio, it's very large, but like I said, it's scalable, and I just wanted a round cash amount. So this portfolio has a cost of $722,000. And so the key is that the tax benefits are based on this larger dollar amount. But like I mentioned, we use seller financing. And so instead of paying the full $722,000, this particular client, and his final numbers weren't this round. They never, feels like they never work out to be totally round. But it was $400,000 of cash that was put into the transaction. And if you look over at the benefit summary, you'll notice that the total tax benefit was $535,608, right? So in other words, significantly more, 134% of what we put into the transaction in tax benefits. I'm also looking at this over a 6-year time frame, and you'll notice the total cash flow over that 6 years is $23,000. I do it over 6 years because that's generally the minimum that you could hold on to these projects. You could also look at it over 30 years, but we're looking at it over 6 years. A couple other details I just want to show is that of the total that we're getting back from this structure, 560,000, we're getting the vast majority of that in the first year through those tax benefits, and then the remainder comes in over, like I said, those next 5 years, years 2 through 6. So what are we looking at here? Well, we have a return of 1.4 multiple, right? 140%. So we get our 400,000 back plus 40% more, right? And most of that comes in tax savings, but some of it comes in cash flow. Like I mentioned earlier, this tax benefit is tax-free, right? So you don't pay taxes on saved taxes. So the multiple is actually the equivalent of a little bit more than 1.34, because in a taxable investment, you'd have to earn more. But, this is a good alternative to paying, writing a $400,000 check to the federal government, right? Over a period of time, you're generating 160,000 of wealth, which will continue to compound and grow your net worth over time that you otherwise would not have. I'm going to pause here because I feel like I'm covering a lot on this. I'm curious if there's any questions. And yeah, feel free to use the chat or unmute. I'm actually going to take this as an opportunity to read Paul's message from a minute ago. Man, this is some pro Apple propaganda.
Hey, Michael, so when you say this individual invested $400,000, I immediately say to myself, like, oh man, I don't have $400,000 of my own money to invest.
Mhm.
Can you invest lower amounts of money? If you're not a, billionaire that, has a bunch of money that you need to put into work. Can I invest $10,000? Can I invest $50,000? Like what does that investment, range look like?
Yeah. So generally speaking, there's going to be two versions of the strategy. One is a version that is on residential properties, and one is a version that's on commercial properties. The commercial properties, you're looking at a minimum cash of over 100,000, usually around 150,000 is the smallest deal that you'll see on a commercial property. And then on the personal side, it's going to be of cash anywhere from 15,000 to 40,000 on residential properties. The numbers work a little bit better on commercial. So for people who have the ability to do something in that neighborhood of 150, that would be worth looking at first. But absolutely, there's other options out there as well.
So for that example, the 150,000, like you could beef up your bank replacement strategy, your whole life policy, borrow the cash value from that, and then invest that into this strategy to have that major tax savings. Is that correct?
Exactly. Yeah. And imagine you do that and then you file your taxes, right? You would have to amend your last 3 years of taxes, and you would get these large checks from the federal government. And then also you could plan that, okay, in current year, your taxes are going to be reduced. And if there's any benefit left over after hitting current year and previous years, you go forward.
So who would this not make sense for?
Good question. I would say it would not make sense. Yeah, good question. The numbers would make less sense the lower your tax bracket is. On the screen right now, if you can see, you'll notice that most of the tax benefit does come from tax credits, like as a percentage, but some of it does come from depreciation. And so, the less income you make, it'll make less sense. Additionally, there's just the complexity of setting it up, and it's a number of hours of due diligence. So it has to be worth it for you when you think about, okay, if I'm going to earn 1.4x on what I'm paying in taxes, is that worth a good amount of your time just to understand it? And generally speaking, when we set up structures like this for our clients, we also do their tax returns, which usually costs a few $1,000s to do the tax return, including all of the setup of the solar company, etc. So I would say, I would put a threshold of past 6 figures of taxable income is where I think you would see some real benefit from it.
That's awesome. Anybody else have any other questions on this?
Okay, great. I'll just go through the last couple slides here. And every time I pause, I end up with problems. All right, here we go. Okay, so I also wanted to throw this in here because I thought it was a funny coincidence that we talked about the bank replacement strategy, which is something that's done by large banks all of the time. And this strategy also is something that large banks do. The intention wasn't to say what are things banks are doing that we can copy. It just sort of ended up that way. But large banks are allocating tens of billions of dollars to this strategy. The same exact banks we looked at just a minute ago are doing, 10 billion, 20 billion into this strategy to reduce their own taxes. Biden passed a bill which passed in 2022, which allocated about $400 billion of tax incentives for renewable energy and things of that nature. And, that's not being used up. 400 billion is not being used up by individuals doing this on a small scale. It's being, it's those large banks putting $20 billion a year into these solar strategies. That's going to use up all of those benefits over, like, let's say the next 10 years. But, large corporations, we all hear about it all the time, are implementing strategies like this one and others to pay less in taxes, to avoid paying taxes. I was looking at Bank of America just before the call for the fun of it. And, 8 years ago or so, they were paying, $7 to $10 billion a year in taxes. And now they're paying about $2 billion a year in taxes. And, I haven't done a deep dive into their returns or their statements, but I'm highly confident a huge reason for that is strategies like this. One thing I'll mention is that corporations, they only have a 21% tax rate, whereas individuals have a 37%. So the numbers actually work better for individuals to do this strategy than the banks that are doing tens of billions of dollars of it each year. But there's different hurdles, on the individual level than the corporations have. That's a big part of where we come in, right? It's one thing to just hear about this strategy and think, oh, that's cool. And it's another to actually implement it. There's a lot of requirements, including getting the deal, having it be turnkey, having someone manage it, etc. And so, those solutions exist and we'll help you out with that. Whereas, corporation doing $20 billion a year, they have, that's enough of a big deal for them to focus an entire team and division on that sort of thing. But yeah, I wanted to just mention real quick 2 big tax changes, which I think a lot of people should be aware of. They kind of affect the solar strategy that we talked today, but this will also just affect, generally speaking, almost every business owner. So I thought I would mention it. So the first is that Inflation Reduction Act of 2022. This was passed by Biden, and it's the act that includes that $400 billion incentives for solar and other similar renewable energy items. Additionally, I think, and the reason why I keep mentioning how large that is just to show, like, we're not the only ones doing this. We're one of the very few doing it for individuals, but corporations are doing this on a massive scale. It's not like it's something that's risky or, like the IRS puts out a dirty dozen of tax strategies that you should avoid. This is nothing like that. This is a very common strategy. It's just unusual for individuals to do it. Normally it's corporations. But that Inflation Reduction Act, it made the numbers work as well as they do, right? Without that, if I had showed you these numbers, they're not going to work nearly as well. Tax Cuts and Jobs Act. This was Trump's tax cuts. I just am educating a lot of people that these are phasing out. Anyone who takes bonus depreciation will probably know that bonus depreciation came down from 100% to 80% last year, and it's down to 60% this year. That's because this Tax Cuts Act is sunsetting. But the big one is January 1st, 2026, all of our taxes are going to go up. Tax rates are going up, like for individuals, and the size of the tax brackets is shrinking. So you end up in the higher tax brackets quicker. And that'll happen on January 1st, 2026. But we might have some relief. There's a bill, it's currently going through Congress. It's called the Tax Relief for American Families and Workers Act of 2024. This bill got through the House. The Senate did not get it through. They didn't even vote on it before they went on recess. So they'll be coming back in a few days. And they're trying to rush this bill through very, very quickly. Their motivation for going fast, it's kind of interesting, is there are a lot of tax credits for, if you have children, and many of them expired in 2023. And so there are quite literally millions of children who will no longer qualify for this tax credit. And it's, bipartisan that this gets reinstated. It's generally credited with keeping literally millions of children who would be below the poverty line. It helps them get above the poverty line. So there's tremendous bipartisan support to get this bill passed. And they want to do it quickly because they want people who are filing now to get this tax credit for 2023, right? They want it to be retroactive. And they don't want it to be complicated and people have to file amended returns and things like that. But one of the big benefits is you end up with, in that bill as it currently stands, is they're reinstating bonus depreciation back to 100% for 23, 24, and 25. And so I assume there's a large number of business owners on the line, or people invest in real estate, and even these solar projects, you take depreciation, you take bonus depreciation. So we're hoping that the numbers are even better than what I showed you if that gets passed. But yeah, last thing I'll do is just say, if you are interested in any of these, feel free to schedule a call with me and my team. We have a QR code on the screen if you want to scan that, or just shoot us an email or a phone number. But yeah, I mean, these strategies, some of many, just to get you thinking about the options that are available out there. If there's a lot of money going towards taxes, it's probably worth, at least a 15-minute call. And I just realized I stopped sharing my screen as soon as I put that QR code up there. I wanted to see all y'all's beautiful faces. So any questions? I'm looking in the Zoom chat right now and I see from Eric, what about prior year taxes? So yes, the solar strategy works for previous year taxes. In the sense that, I'll explain how it works just real quick, is first, when you do a project like this, it's going to reduce your current year taxes. But then if you get those to zero or as close to zero as you can get, you're able to take whatever excess benefit that you have and go and apply it to previous years. So just depending on what your income is and how much solar projects you purchase will determine how far back you can go, can you get it all, etc. And then once you've exhausted the past, you can go forward. And David, yeah, it also helps that we are in an election cycle. I think there's a lot of motivation to get this done. In fact, some people were saying everyone will love this bill so much that maybe Republicans won't want to pass it to give Biden a victory in an election year. It doesn't seem like that's likely. This bill has so much bipartisan support. But just to give you an idea of how well supported this bill is and how likely it is to get through, almost everyone agrees that this bill will help our economy. It's hard to find people who are against the child tax credit. And there's a few other changes in there which most people tend to agree with. And so the bill has a ton of bipartisan support. But yeah, Tony, thanks for joining us for the call. Seeing you're hopping off there. But yeah, Stu, David, anyone else, any questions? I feel like we covered a lot.
Yeah, man, this was awesome. No questions on my end. I had a one-on-one counsel with you prior to this, so I mean, I'll say that guys and gals, not just this strategy is something that Michael knows about. I mean, they have a ton of different strategies to go through specifically on your own situation. So if you are looking to reduce taxes, I would highly recommend setting up a call with Michael and talking with his team. This is awesome, man. I think education knowledge like this is always great to have. We'll put this up on our podcast as well, but for anyone that didn't make it, we'll also send this out in an email for those that registered. Yeah, everyone, thanks for joining us live. And David, you got anything else?
No, Michael, thank you. Always appreciate you and Will, and just the, you know, the information, and just getting us thinking, right? Getting us thinking critically and thinking about the different ways that we can that we can do things differently, and that we can you know, education is critical, right? The investment of this time and the things that you talked about, the yield on that can't be really captured on a slide very easily, but it's an infinite ROI. So thank you for that.
Absolutely. Well, thank
All
you
right.
both.
Yeah, thanks, Michael. I appreciate it. I'm going to end the call, and anyone wants to stick around, feel free.